Good morning, Daily Hunters, and welcome to your Friday market kickoff. It's October 11th, 2025, and we've got a fresh batch of insights to help you start your weekend research.
Great to be here, Ethan. And looking at the data we crawled overnight, it's a really interesting mix. We've seen a noticeable uptick in public discussions around a handful of stocks today. It's not a huge spread of companies, but the ones popping up have quite a bit of engagement.
Absolutely, Brooke. There's definitely some buzz, and I'm seeing a few candidates with some really compelling growth stories, potential for a nice run. Companies showing strong fundamentals.
While that's exciting, Ethan, I'm also seeing a fair bit of what I'd call high-risk speculation in the mix. Some of these are showing really strong sentiment from the community, but when you dig into the core KPIs, the numbers are flashing some serious warning signs. So we'll need to balance that enthusiasm with a good dose of reality today. Let's jump in.
All right. First up on our radar today is DTE Energy Company, ticker DTE. Now, this is a new one for our show, and the AI-generated insights are pretty bullish. We're seeing robust revenue growth for a utility company, almost 19%, which is just fantastic, plus a solid 3.1% dividend yield. It's trading near its 52-week high, showing great momentum.
It's true, Ethan. DTE's revenue growth is impressive for its sector, and that dividend yield is definitely appealing for income-focused portfolios. But let's not ignore the mixed analyst sentiment here. While UBS and Jefferies raised targets, Scotiabank actually downgraded the stock, and Morgan Stanley reduced its price target. It suggests some caution on valuation after these recent gains. The PE ratio is sitting at 20.21, which is fair, but we've got to watch that debt-to-equity ratio at over 200%.
Well, it's a utility, Brooke. They often carry more debt. And with that kind of consistent revenue growth and a low beta of 0.422, it shows stability. For me, DTE presents a strong case for investigation as a potential buy. That revenue growth, attractive dividend, and positive price momentum are really compelling.
All right. With that growth and dividend, I can see the appeal for a deeper look. DTE is a buy for now, but keep an eye on that debt.
All right. Next, let's talk about Interactive Brokers Group, Inc., symbol IBKR. This is another new one for us, and the internal analysis is quite mixed. While the AI flagged a specific user complaint about IBKR prematurely closing positions and causing lost profits, it's worth noting that the broader social media comments didn't actually focus on the stock itself.
That's right, Brooke. And the external data really tells a different story for the stock. We're seeing Rothschild, Barclays, and Jefferies all raising their price targets, some up to $81. The stock is trading near its 52-week high, and the company has fantastic revenue growth at 18.8% and a net profit margin of almost 15%. This suggests strong business health despite that isolated user experience.
I agree that the analyst upgrades and strong financials are hard to ignore. The stock's journey from a $32 low to almost $70 is quite a run. However, that single user complaint about platform reliability is a significant operational risk. If it's not an isolated incident, it could impact client retention down the line, affecting those strong KPIs. It makes me a little cautious.
I hear you on the caution, but the fundamental strength and analyst confidence are just too strong to overlook. For IBKR, based on those strong price targets, historical performance, and solid financials, our AI-generated insights lean towards a buy. It's definitely worth a closer look.
I'll concede to a cautious buy on this one. The market seems to love it, but that user feedback is a point to monitor closely. All right, now let's turn to Berto Acquisition Corp, or TACO. This is a new mention, and the hot leads count spiked with 92 discussions, which got our attention.
And a spike it was, Ethan, but the public discussions were totally irrelevant to the company. The word taco was used in a meme-like context, not about the stock. When you look at the company's actual KPIs, it's a clear stay away. Net profit margin is 0, operating margin is 0, and there's no free cash flow data available. Plus, it's trading near its 52-week low.
Yeah, sometimes the market buzz can be misleading if you don't dig in. Without any profit, it's really hard to see a path to growth.
Exactly. A zero net profit margin and operating margin are critical red flags. Coupled with being near its 52-week low, our market commentary suggests you stay away from Taco.
All right, moving on to Robinhood Markets Inc., ticker HOOD. This is a stock we've discussed frequently, and unfortunately, it's been a consistent stay away in our past ratings, including just a few days ago on October 9th. Today, we saw a user rolling profits into long-dated call options, indicating strong bullish conviction for a future rally.
That's exciting. And you know this user's action makes sense when you look at some of the numbers. Hood has seen substantial growth from a $23 low to nearly $139. Revenue growth is a robust 45% with a net profit margin of almost 50%. Plus, its high beta of 2.43 means big moves, which is what option traders are looking for. News also suggests it's advancing while the market declines, and it's seeing upgrades.
Ethan, I get the enthusiasm from that specific user, and the revenue growth is compelling, but my KPI alarm bells are ringing loudly. A PE ratio of 70.53, a price to book of over 15, that's an extremely high valuation, implying massive future growth is already baked in. Any slight disappointment could lead to a steep decline. And let's not forget that debt-to-equity ratio of 161.17. That's a lot of leverage.
But the user's making money, Brooke, and the company is growing. It's a growth stock. These can carry higher valuations.
They can, but a PE of 70.5 combined with that debt is a significant risk for new investors, especially when considering its frequent classification as a stay away in our past commentary. The potential downside is considerable. Our AI-generated insights suggest for the average investor, it's still prudent to stay away from Hood. All right, next up we have Processa Pharmaceuticals Inc., or PCSA, another new one on our list today. We saw some discussion around its potential to explode with a mathematical projection of 400% gain if it hits a $100 million market cap. Sounds pretty enticing, right?
It sounds exciting on paper, Ethan, but the reality is quite different. The analysis itself mentioned PCS has a large float, meaning it needs significantly more capital to move the price. More importantly, the financial KPIs are deeply concerning. The company has a net profit margin of 0% and negative EPS of negative 2.31. It's consistently losing money.
Well, they did get some media exposure with interviews on Bloomberg TV, and there were some insider stock buyers recouping losses. That suggests some belief in a turnaround.
Recouping some losses isn't exactly a ringing endorsement, Ethan. It means insiders were previously underwater. A beta of 1.524 indicates high volatility, and for a company that isn't profitable and is losing money, that volatility translates directly to extreme risk. Based on its severe unprofitability and high volatility, our market commentary advises you to stay away from PCSA. Finally, we need to talk about Connexa Sports Technologies Inc., now YYAI. This one generated a lot of hot leads today, and we saw some very enthusiastic community sentiment, with users saying things like YYAI ready for takeoff and I'm all in YYAI, Jim, hurrah, rocket. This is a new one for us, but it's definitely got people talking.
And with good reason, Brooke. They've rebranded as AirWA Inc. and are launching AirWA Exchange, backed by a confirmed $100 million investment and a $500 million definitive agreement. That's a massive pivot into a potentially lucrative market. The community sees exponential price movement potential, with projections of 3,233% gain if it hits a $100 million market cap from its current tiny $2.76 million market cap. That's the kind of growth story that captures attention.
Ethan, I understand the excitement around a rebrand and significant investment, but we have to look at the cold, hard numbers. Despite all that positive news, the stock's historical performance is catastrophic. On October 7th, just a few days ago, the price collapsed from 2.73 to 0.1899. That's over 90% of its value wiped out in a blink. It's currently trading barely above its 52-week low.
But the new capital, Brooke, and a new direction. Maybe the market just hasn't caught up to the news yet. Those low PE and PB ratios could suggest it's incredibly undervalued now.
Or they could suggest the market has deep distrust in the company's assets and future value, especially after such a severe price collapse. We also have negative revenue growth of 8.3% and a very high debt-to-equity ratio of 2.819. While the community is incredibly bullish, the market itself has labeled it a top pre-market decliner and top midday decliner. A 90% price crash, high debt, and negative revenue growth, despite a big new investment, is just too much risk. Our AI-generated insights strongly recommend you stay away from YYAI.
Section 3. Today's candidates for deeper analysis.
All right, Daily Hunters, it's time to consolidate our thoughts for today.
Remember, these are potential areas for your own deeper dives.
Investigate as buy, DTE Energy Company, DTE.
Investigate as cautious buy.
Interactive Brokers Group, IBKR.
And now for today's speculative gamble. This is the stock that, despite our stay away classification, captured the community's wild optimism.
Investigate as speculative gamble, Connexa Sports Technologies Inc., YYAI. Section 4, disclaimer and goodbye.
As always, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred.
The market is a wild place, and knowledge is your best asset. The data we've discussed is compiled from publicly available sources to save you some time and set your focus for your own research. But it could be outdated. Always do your own due diligence.
That's it for the Daily Hunt this Friday, October 11th, 2025. Thanks for tuning in and happy hunting.
See you next time.